This is OG John. The markets are closed. It's Saturday. If you've been here for a few weeks, you already know what that means. Weekends are not a time to relax. They are when the architecture of the next week is built. Every development, every data point, and every escalation is monitored. If you're paying attention, leave OG in the comments. Don't skip this. The one thing that might change how you see everything comes at minute 8. And if 10 minutes is too long for you, the mainstream already has plenty of 30-second videos waiting. Let's begin. In the West, silver closed Friday at $84. In Shanghai, it costs $96. Physical silver in the East is now 14.5% more expensive than Western paper silver, and that gap has been widening session after session. Over the last few days, the sequence has been 13.5%, 13.8%, 13.7%, 14.5%, 14%, and now 14.6%. That is not random noise. The movement is directional, and it tells you exactly where the real demand for physical metal is concentrated. There's another layer underneath this. Professional buyers have been pulling physical silver and gold out of the COMEX day after day. Institutional players are taking delivery of real metal session after session. At the same time, the Sprott Physical Silver Trust is trading at a 5.7% discount. Retail investors are not buying yet. Silver has not returned to Western retail interest, and that distinction matters for anyone who understands market structure. For context, the Sprott Trust averaged a 17.3% premium during 2011, the last major silver bull market. Today, it trades at roughly a 6% discount. That means this move has not been driven by speculative retail mania in the West. It has not yet reached the stage where froth forms and collapses quickly. If Western retail does return once price action becomes impossible to ignore, the shift from a discount to a premium alone could significantly multiply returns beyond the raw price movement. Now step back and frame the geopolitical environment because none of the silver data exists in isolation. The situation intensified across several fronts simultaneously. On Friday, we saw WTI crude record its largest weekly increase since 1983. Over $900 billion was wiped from U.S. stocks in a single session, and the Strait of Hormuz effectively closed to vessels connected to the West. Since then, the situation has evolved further. Iran attacked a multi-flag tanker near the Strait of Hormuz. The U.S. Navy is preparing to send a third aircraft carrier to the Middle East. 1 carrier is presence. 2 is a warning. 3 represents an entirely different operational posture. Israeli forces carried out large overnight strikes on military targets around Mehrabad Airport and across Tehran. At the same time, a major escalation occurred when a freshwater desalination facility on Keshem Island was struck. According to a U.S. intelligence assessment, even a massive military operation may not successfully overthrow the Iranian regime, and Iran's foreign minister has issued strong warnings in response. Look closely at the messaging. Some observers interpreted Iran's president saying strikes against neighboring countries could stop as a sign of de-escalation. It isn't. Iran is speaking to its regional neighbors, not to Israel or the United States. That language functions more as a pressure tactic designed to create distance between Gulf states and the Western coalition. Meanwhile, former President Trump publicly declared Iran defeated while simultaneously threatening total annihilation. Both statements cannot be true at the same time. The contradiction does not indicate stability. It signals a conflict that remains unresolved. In energy markets, Oman crude moved above $100 per barrel this weekend. Oman crude is the main pricing benchmark for Middle Eastern oil heading to Asia, which makes the move significant. Even if it has not yet spread across all benchmarks, when one key benchmark breaks higher, it rarely stays isolated. The Strait of Hormuz remains closed, and Qatar has declared force majeure on LNG shipments after shutting down the Ras Laffan facility, one of the largest LNG production sites in the world. Qatar supplies roughly 20% of global LNG, and restarting production could take a month or more. This is not simply a price spike. It is a structural supply shock hitting a market that was already strained. At the same time, U.S. strategic messaging has been unusually direct. The head of the National Energy Dominance Council openly stated that the long-term objective is to remove control of global oil from current producers so that the United States would eventually no longer need to worry about the Strait of Hormuz. That is not hedging language. It signals a strategic timeline that likely extends far beyond days or weeks. Europe may be the most vulnerable region in this entire scenario. Before the Ukraine conflict, Europe depended heavily on cheap Russian pipeline gas. That supply is gone. It was replaced with more expensive LNG imports, much of which now comes from the United States. Russia has already begun rerouting its remaining LNG flows toward China and India, even before new EU sanctions fully take effect. With the Hormuz corridor disrupted and Qatar temporarily offline, Europe has few alternatives. Gas prices have already jumped more than 50%, and because the United States now supplies over half of Europe's LNG, Washington effectively influences the price of European industrial energy. If this disruption continues for several weeks, the discussion shifts from high energy prices to factories shutting down permanently. Economist Jim Rickards described the mechanism behind this scenario clearly in Currency Wars. Inflation caused by energy supply shocks cannot be solved by raising interest rates. If central banks raise rates during a supply-driven inflation event, economic activity collapses, but the price pressure remains because the underlying supply problem hasn't changed. That is the environment the Federal Reserve may now be facing after the oil move we discussed yesterday. In those conditions, scarce real assets tend to respond differently. Historically, they do not weaken, they strengthen. There's also a broader macro framework that many analysts are discussing. Conflicts near major energy choke points function like a global silent tax. When oil prices rise, transportation, agriculture, shipping, manufacturing, and logistics all become more expensive. Every consumer on the planet pays the cost without any political vote. This is where the monetary structure connects to the energy system. Because oil is priced in US dollars, any country that needs energy must first obtain dollars in order to buy it. Demand for energy becomes demand for dollars. A significant portion of those dollars historically flows back into US Treasury markets, reinforcing the financial system that supports the structure. China's actions provide another important signal. The People's Bank of China increased its gold holdings for the 16th consecutive month, adding roughly 30,000 troy ounces in February and bringing total reserves to 74.22 million ounces. This is not tactical hedging. It is a consistent structural reallocation of reserves. According to the World Gold Council, global central bank gold purchases slowed sharply earlier this year. Net buying in January was only 5 tons, compared with a 12-month average of 27 tons. China did not slow down. It continued accumulating. At the same time, some countries are moving in the opposite direction. The head of Poland's central bank suggested selling gold reserves to fund defense spending. Even so, overall demand from central banks in Central and East Asia remains strong. The rising Shanghai silver premium directly reflects where that demand is concentrated geographically. Another development in the silver market is worth noting. For the first time in decades, silver is no longer the commodity with the largest days to cover concentrated short position. That position is now held by platinum. Over the last 6 months, the largest 8 commercial silver traders have been actively reducing their short exposure. The 4 biggest dealers still hold substantial short positions, likely concentrated within 2 major U.S. banks, but traders ranked 5 through 8 are now holding the smallest short positions in history. When the institutions that historically provided the most consistent selling pressure in the silver futures market begin reducing exposure at this scale, the paper system that contained price discovery for decades starts to weaken structurally. Anyone can verify this by reading the Commitment of Traders report, which is released publicly every week. Of course, there's always a counter-argument. In the short term, paper markets still dominate price discovery. Silver prices can fall quickly if algorithmic selling triggers, if the US dollar index reverses, or if a sudden ceasefire headline appears. Another factor is the COMEX leverage ratio, which still sits near 7 paper ounces for every registered physical ounce available for delivery. That ratio can suppress prices temporarily before any eventual physical resolution occurs. Paper markets and physical supply do not converge gradually. When they do converge, it tends to happen suddenly. For long-term silver holders, the framework is different. A weak week or even a weak month does not change the structural deficit. The short covering trend developing in silver is a multi-year process, not a weekly signal. Global uncertainty is now higher than during the financial crisis, the dot-com crash, or even the pandemic. In that type of environment, scarce real assets historically maintain or increase their value over time. One final detail worth monitoring over the weekend: while traditional markets close, tokenized gold platforms like Kinesis and Pax Gold continue trading. IG's pricing models also operate outside standard spot markets. These are not perfect indicators, but they can offer a rough preview of where metals might open on Monday. So far, both gold and silver are trading close to Friday's closing levels. Nothing significant has moved yet. Oil, however, has continued drifting slightly higher on IG's spot pricing model. For now, watch 3 things carefully: the Shanghai silver premium, COMEX registered inventory levels, and the weekly commitment of traders' data. Every data point I referenced is public. Verify it yourself. Don't take anyone's word for it, including mine. Invest rationally, not emotionally.